You're told to invest in the stock market. But let's be honest, it feels like a secret club for rich guys in suits. They use words like beta and EBITDA, and you're just wondering if you have enough money for extra guacamole. So Buck has a question, a really basic one. Okay, seriously, what even is a stock? Is it just magic internet money? Turns out, it's actually much simpler. A stock is just a tiny slice of a company. Imagine your favorite coffee shop. When you buy one of their stocks, you basically own one single coffee bean in their giant sack. You're not just a customer anymore. You're a part owner. A very small part owner. Buck's next question is obvious. But why would a company sell little pieces of itself? They do it to raise money for cool new stuff, like building a new factory or inventing a coffee cup that never gets cold. It's like a giant bake sale for a corporation. They sell slices of their company cake to get cash for their big ideas. This way, they don't have to take out a huge loan from a scary bank. Okay, that makes sense. So Buck owns a tiny piece. Now he asks, so why does the price go up and down like a moody teenager? It's all about supply and demand. The simple feeling of I want that versus get rid of this. If Awesome Coffee Corp invents a new donut that cures Mondays, everyone will want a piece of that company. More buyers than sellers means the price of each slice goes up. Your little coffee bean is now worth more. But what if their new donut tastes like dirty socks? Suddenly, nobody wants to be an owner. People rush to sell their slices. More sellers than buyers means the price plummets. Your coffee bean is now a sad, shriveled little raisin. So you want to own slices of companies that are good at making donuts, not socks. This whole thing is happening millions of times a second in a place called the stock market. It's not a physical place anymore. It's a giant computer network connecting buyers and sellers all over the world. Just as Buck is wrapping his head around that, he remembers something he heard. Wait a minute. I heard companies sometimes just give you money, like for free. Yes, that's called a dividend. It's not exactly free money, though. It's your money. Remember, you're an owner. So when a company does really well and has extra profit, they might share it. It's their way of saying, hey, thanks for owning a piece of us. Here's your cut. Not all companies do this. Younger ones often reinvest all their profits back into growing bigger. But older, more established companies might send you a little cash reward a few times a year. Now Buck is starting to see the appeal. But a new thought creeps in, a slightly scary one. Okay, but this sounds a lot like gambling. Am I just putting my life savings on red at a Vegas casino? Honestly, it can be. If you bet everything on one single company, that's incredibly risky. Because if that one company's sock-flavored donuts fail and they go bankrupt, poof, your money is gone. It's like putting all your eggs in one basket and then tripping over a rock. But smart investors don't do that. They do something called diversification, a fancy word for a simple idea. It just means don't put all your eggs in one basket. Instead, put one egg in lots and lots of different baskets. You buy a tiny slice of the coffee shop, and the video game company, and the car maker, and the people who make yogurt. That way, if the coffee shop starts making terrible coffee, your video game slice might be doing great. It balances out. If you're finally having that aha moment about not gambling away your future, do us a favor and hit subscribe. We make this stuff less scary. Which leads to Buck's final, most important question of all. Okay, how does a normal person like me actually do this? How do I buy a tiny piece of everything without my brain melting? You don't have to pick them one by one. That's for the Wall Street guys. For the rest of us, there's a magical invention. It's called an index fund, and it's probably the most brilliant, boring way to build wealth ever invented. Think of it like a pre-made salad bar. You don't have to pick every single vegetable yourself. An index fund is like buying one big bowl that already has a little bit of everything in it. For example, an S&P 500 index fund automatically buys you a tiny slice of the 500 biggest companies in the U.S. One click, and you're diversified. You own a piece of Apple and Amazon and pretty much everyone else. You're no longer betting on one single company to succeed. You're making a broad, simple bet on the entire U.S. economy to grow over time. And historically, over the long run, that has always been a very good bet. There will be scary drops. Recessions will happen. The line will go down, and the news will freak out. But the secret is to just do nothing. Keep buying regularly, and let time do the heavy lifting. This isn't a get-rich-quick scheme. It's a get-rich-slow plan. It's not a lottery ticket. It's a savings account with superpowers. You just add a little bit every month and let the power of compound interest work its magic over decades. That's how regular people build wealth, not by trying to be geniuses, but by being consistent and patient. What's the one finance term that's always made your brain short-circuit? Let us know in the comments. So let's recap Buck's journey. He started out thinking stocks were weird magic for rich people. He learned a stock is just a slice of a real business, like a pepperoni from a pizza. He figured out prices move based on how much people want that slice, which depends on if the company is making good stuff. He learned about dividends, the little thank you payments from companies with extra cash. And most importantly, he found a cheat code for normal people: index funds. The simple, boring way to own a piece of everything and bet on humanity to keep growing and innovating. The stock market isn't a secret club. It's a tool that, used slowly and patiently over time, lets you turn your work today into wealth for your future.